Hello friends. If you are within 3 years of retiring and you have a traditional IRA, I want to describe 3 things that may already be happening to your retirement finances quietly, without any notification, before you have made a single decision you cannot undo. The first, the Social Security check you will receive on day 1 of claiming carries a number that gets locked in permanently from that moment forward and never adjusts upward regardless of what the economy does, regardless of what Congress passes, regardless of how long you live. Most people, 3 years from retirement, cannot tell you that number with any specificity. They have a general plan, but they have never run the actual number that connects their claiming age to their IRA, their tax bracket, their required minimum distributions, and their Medicare premiums, all 4 systems together as one picture. The second, if your traditional IRA keeps growing untouched until the IRS begins requiring you to withdraw from it in your 70s, those forced distributions will stack on top of your Social Security income above a threshold. The IRS set in 1993 $44,000 in combined income for married couples. 85% of your Social Security benefit becomes federally taxable ordinary income. That threshold has never been indexed for inflation. For many retirees with meaningful IRA balances, hitting it is not a risk. It is the default. The third, your Medicare premium at 65 is not determined by what you earn at 65. It is set by what you earned at 63. The official Medicare website confirms the surcharge mechanism. The first IRMAA tier begins at approximately $106,000 in modified adjusted gross income for single filers in 2025, with the exact current year figure on the official Medicare website. And if you take large taxable IRA withdrawals in the 2 years before Medicare enrollment without a plan, you may lock in a surcharge level premium that follows you permanently, based on income you earned before your first Medicare card ever arrived. 3 things, all of them already in motion, and every single one of them is still manageable if you act before the window closes. The window is open right now. It is not open at the moment you file for Social Security. Stay with me through the full picture, because the second half of this video is where all 4 systems come together and look completely different from any of them seen separately. Quick context before we go further. This video is made for Americans within 3 to 5 years of claiming Social Security who hold a traditional IRA. The goal is to help you understand how Social Security, your IRA, your tax bracket, and Medicare interact in ways that most content explains separately, but almost never together. Everything here draws from publicly available official information, the Social Security Administration, the IRS and the Secure Act rules updated in recent years, and the official Medicare website, and I will name each source as we go. This is educational content only. It is not personalized financial, tax, or legal advice, and nothing here is a promise that you will receive any specific amount of money. Everyone's situation is different. Before any major decision about claiming age or IRA strategy, talk to a licensed tax professional who knows your numbers. Now, let us get into what actually matters. How many years from retirement are you right now, and have you actually made a Social Security claiming decision, or is that still open? Drop your situation in the comments below. The most specific questions become future videos. Let us start with that Medicare surcharge mechanism, because it is the most invisible of the 4 systems. When you enroll in Medicare at 65, the program looks at your tax return from 2 years prior to set your premium the 2-year look back. If your modified adjusted gross income in that year exceeded the IRMAA threshold, your Part B premium jumps significantly at the first surcharge tier, a bill set 2 years before it arrives. A retiree who took large traditional IRA withdrawals at 63 without a conversion plan may arrive at Medicare enrollment already committed to surcharge level premiums, and once required minimum distributions begin, an ongoing pattern of large, taxable IRA withdrawals can generate IRMAA surcharges year after year on income. The IRS compels you to take. Now add the Social Security taxability layer. The IRS calculates combined income as adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefit. For single filers, once that figure crosses $34,000, up to 85% of Social Security is federally taxable ordinary income. Per the IRS, for married couples filing jointly, that upper threshold is $44,000. Pause here and write that down. Married couples combined income above $44,000, 85% of Social Security is taxable. The IRS set that threshold in 1993. It has never been indexed for inflation. What was a relatively high retirement income then is a standard one today. For many retirees drawing from a traditional IRA, hitting 85% taxability is not a risk. It is the default, but a retiree who converted a meaningful portion of their traditional IRA to Roth in the gap years before Social Security began now draws from the Roth tax-free in retirement. Those Roth distributions generate zero combined income. The Social Security taxability calculation stays lower. This is not a loophole. It is the direct interaction of IRS rules and SSA rules, and it works in your favor whether those two agencies designed it together or not. Two additional factors consistently change the optimal claiming age in ways people underestimate. The first is the earnings test. The Social Security Administration confirms that if you claim before your full retirement age of 67 while earning wages above the annual limit, approximately $22,000 to $24,000, with the exact current figure on the official Social Security website, your benefit is reduced by $1 for every $2 earned above that limit. For anyone planning consulting or part-time income in early retirement, claiming before 67 carries a direct annual cost. The second factor carries more weight than anything else in this video for married couples. When one spouse dies, the surviving spouse keeps the higher of the two Social Security benefits, the lower one stops. That means the higher earner's delay decision is not a personal income calculation. It is the income floor the surviving spouse may live on alone for 10, 15, or 20 years. The Social Security Administration confirms that waiting from 67 to 70 earns delayed retirement credits of 8% per year, a total of 24% above the full retirement age amount, on a full retirement age benefit of $2,500 per month. The difference between claiming at 62 and waiting to 70 can be more than $1,300 every single month for the person left behind. Over 15 years, that difference represents more than $240,000 in additional lifetime income for the surviving spouse. Pause here and write this down. Take the higher earner's full retirement age benefit, multiply by 30%. Then multiply that monthly figure by 180 months. That number is what the delay decision is actually worth to your spouse. The break-even calculation most people use never includes it. Have you ever run that survivor benefit number for your own situation? I want to hear in the comments, because this is the one that changes everything for married couples, and it is almost never framed this way. The benefit amounts themselves are built on a compounding base. For anyone born in 1960 or later, the Social Security Administration confirms full retirement age is 67. Using an illustrative $2,300 full retirement age benefit, not a promise of any specific payment, simply a structural illustration, claiming at 62 yields approximately $1,610 per month. Claiming at 70 yields approximately $2,850. The Social Security Administration confirmed the 2026 cost of living adjustment at 2.8%. Applied to a larger base, it generates a larger dollar increase every year. The gap between the 62 claimer and the 70 claimer does not hold steady. It widens for as long as both are alive. Consider David and Charlotte an illustrative composite consistent with IRS and SSA data. Not a verified real case. David retires at 66 with a $550,000 traditional IRA. They claim Social Security immediately. No Roth conversions are made. At 73, David was born before 1960. So the IRS required minimum distribution age of 73 applies to him. Forced IRA distributions begin. Combined with Social Security, their combined income crosses $44,000. 85% of his Social Security is federally taxable every year. Medicare premiums have hit the first IRMAA surcharge tier based on IRA income 2 years prior. 4 systems, all working against them at once. Not from bad luck, but from a gap year window never used. That window is what every section of this video has been building toward. The gap years, the period between when wages stop and when Social Security begins and required minimum distributions kick in, represent the lowest taxable income window most people will ever experience in retirement. And here is a correction to something many videos in this space get wrong. The Secure Act, confirmed by the IRS, set the required minimum distribution starting age at 75 for anyone born in 1960 or later, not 73. Write this down. Born 1960 or later required minimum distribution age is 75, per the IRS. That correction adds 2 full years of low-income bracket space to the planning window for the exact audience this video. Addresses 2 years that most people do not know they have. During those gap years, the IRS 12% federal bracket creates the conversion opportunity with the standard deduction and the age-based additional deduction for those 65 and older current amounts on the IRS website. A single filer can convert a meaningful amount from a traditional IRA to Roth at 12% or below. A married couple, both over 65 stacks higher combined deductions. If recent federal tax legislation, a senior bonus deduction of $6,000 per person available through 2028 for those 65 and older applies to your situation, the available bracket space is larger still. Verify eligibility with the IRS or a licensed professional because income phase-outs apply. One critical caveat: if you are between 60 and 64 on marketplace health insurance under the Affordable Care Act before Medicare eligibility, conversion income counts toward modified adjusted gross income under the IRS and the Affordable Care Act rules. And a large conversion in a single year can reduce or eliminate your premium subsidy. Model that interaction before setting any conversion amount. Every dollar converted in the gap years at low rates is a dollar that will never generate a forced required minimum distribution. Never push Social Security above the 85% taxability threshold and may be inherited tax-free rather than taxed under the 10-year inherited IRA rule. A retiree who retires at 66, delays Social Security to 70, funds living expenses from the IRA, and converts remaining bracket space to Roth. Each year arrives at 70 with a higher Social Security base. A smaller traditional IRA, lower required minimum distributions, and Roth assets generating 0, combined income keeping the Social Security taxability calculation lower, and Medicare premiums potentially at the standard rate because modified adjusted gross income was managed during the 2-year look-back window. One decision, 4 systems shifting in the same direction at once. Which of these 4 systems was the one you had not clearly connected to the others before today? Drop that in the comments. Your answer tells me exactly what the next video needs to cover. Here is your 3-step action plan. 3. Log in to the official Social Security website and find your projected benefit at 62, 67, and 70. Those 3 numbers are the inputs to every calculation we walked through today. 2. Pull your most recent traditional IRA statement Estimate what 10% of that balance looks like as annual income. Stack it on top of your full Social Security benefit and compare it to the $44,000 IRS combined income threshold. That calculation tells you whether the taxability problem is real for your specific situation. 1. Talk to a licensed tax professional who understands both Roth conversion strategy and Social Security timing before any major decision. This video gave you the framework. A licensed professional applies it to your actual numbers. If you have a spouse, an adult child, helping a parent plan, or a close friend within 5 years of claiming Social Security with a traditional IRA, share this now. The window we discussed closes by age. The Social Security Administration does not send a reminder when it is narrowing. Sharing this before they hit it is genuinely useful. The next video looks at what this framework changes when one spouse has a pension, because pension income interacts with the combined income threshold in a way that shifts the entire conversion calculation. Subscribe now so you do not miss it. And if the integrated picture in the second half landed differently than the individual systems did early on, go back to roughly the 9-minute mark and watch it again. It reads differently the second time.